The following is a presentation of TFNN.
Good afternoon, folks. Welcome to our Wednesday, June 13th edition of our Celestial Charting Mastering Probability webcast. As we kick this off right now, you've got the Dow is down about 69 points. S&Ps are off 7 points. And so let's go ahead and begin with our webcast. As far as our next webcast here, with it being the summertime, we've got a couple of changes to dates. We will have our next webcast will be next week. Thanks for allowing me to postpone last week's. It was just going to be difficult for me to do a 5-hour session doing 2 hours in the morning, 2 hours of Tom show, and then this webcast here. So we will have another webcast edition next week on Wednesday. Then we're going to 2 weeks after that is July 4th. So we'll skip July 4th. We'll go to July 11th and then back-to-back July 18th. And then from that point forward, we should be pretty good with every other week. So that's the schedule. If you want to go ahead and mark that on your calendars, that would be great. And let's see here. So now, what the things that I'd like to cover today, the areas I'd like to cover, I'd like to take a look at what the current lunar cycles, the ones that are on our horizon, take a look at the charts, what's been going on, an ES mini update, take a look at the S&P futures contract, just pick up from this morning's newsletter chart, take a look at just the general market action today, the current trades that we're in, as well as the new trades that we're taking a look at. Then I want to spend time on the 50-day, 200-day, monthly exponential moving averages, the crossovers. Some of you have sent in to me some of the options that you have, you or your spouses or children have inside your 401k accounts. So I want to take a look at those as well. And then what I have been doing, if you have taken a look at the Celestial Charting archives, there's about 20 hours now worth of content there, and we're going through each of those to create a table of contents that I'll go ahead and have posted with inside the newsletter as a link, so that if you're looking for some specific aspect, you're looking for some specific education, it'll make it easier for you to figure out which webcast to go back to. And then, as always, questions and answers, and a small group this morning, so feel free to, this afternoon, feel free to go ahead and type in any questions as we go along. And so let's take a look at the cycle that we're dealing with really right now, which is last Monday's lunar eclipse full moon cycle on June 4th. And the next lunar cycle that we have is actually a new moon, but it's really last. We'll speak right now about last week, Monday. Take a look at the charts. And so we had that full moon solar eclipse, and what we had occur on Sunday was the perigee. And we will go ahead and pull up the perigee chart just so you can take a look at that. Again, it is certainly an aspect that works very well for determining whether you should be long or short the market, and we'll take a look at that. We've covered that a number of times here during the Celestial Charting Mastering Probability webcasts. In fact, let's go take a look at it right now. I won't go live to it. I'll go to the one that was posted as of about an hour or two ago. And, what I do have here, and you would want to also post on your chart, and I'll go back here real quickly. The last perigee lunar phase came in on Sunday. So when it comes on Sunday, you don't know whether to draw your line at the close on Friday or the open on Sunday. In this case here, the close and open were very near the same area, so it became pretty easy to do. We'll have to see when we come to this weekend whether that is the same or not. And so what I have drawn in here, and what is very critical at this stage from my standpoint, is the full moon low that came in last Monday. If that area were to get broken out anytime soon, meaning the next couple of days, that would indicate significantly lower prices coming at us. But as you can see, the perigee and the apogee lunar phase, you want to be long the markets when price is above it and short the market when price is below it. It's probably the most successful trading strategy that I know of. Now, you do have to pay attention to ABCs and stops. There are always, not always, but oftentimes in the initial time period, there are times where you may get jockeyed in and out of the marketplace, but it is a lunar phase that absolutely pays off well. Again, I mapped this on the S&P futures contract, and as opposed to trying to map it over on some ETFs, you can do that. I've provided you with the dates for that in prior all those perigee and apogee lunar phases, but it absolutely works great. And I'll actually go ahead and I'll pull the chart up, and let's take a look at where we're actually at right now. So we'll kind of take off from this morning's newsletter here as we take a look at that 30-minute chart on the ES Mini. And what we can see is certainly that the ES Mini has been providing us, again, with good A to B equals CD patterns. The most recent two, the one off of the high from Sunday evening when the S&P made a high in the 1342 area. Now, when you're drawing your A to B equals CD patterns, you have to be open to redrawing them as you have additional information to us. In our case here with this AB equals CD down, even on the small pattern that was drawn, the initial small pattern here, which was first drawn, we never got a bullish signal to go long the market, other than right in here as it was making a 1 to 1.618 A to B equals CD. This candle right here was a bullish engulfing, and it closed just slightly higher on the following candle. And you could have, that was if you take a look in the upper left-hand portion of my screen. Hopefully you can see it in the green area. It shows 9:30. This is a 30-minute chart. Now, I'll go ahead and actually pull up the 10-minute chart, because when you are trading, I think when you're trading anything, you want to have a couple of multiple charts, multiple time frame charts up. And I had the 30 and the 10-minute time frame chart up at the same time, and especially as you were coming into the 9:30 into the open right here, and you can see as soon as the market came into the open. Now I'll put it on the 10-minute chart because it shows itself a little bit. It shows itself much better, actually. Let me go ahead and get rid of some of the data that's on here. So let me come back in here, and this candle right here, this is the 9:30 to 9:40 time frame. This you can see you got the volume that came out of the marketplace at that stage. So even though on the 30-minute chart we had our bullish engulfing candle, was really these three green candles that we're taking a look at, and but so the reason why you want to have multiple charts up here, and especially as you're coming into the open or the close if you're placing a trade, because you can have so much volume at that stage. So just simply by waiting just a few more minutes here, it was giving you the signal that even on the 30-minute chart, even though that was the only, I'll go back to it, that was the only bullish signal you had in an A to B equals CD pattern, by having multiple charts up on the screen, it gave you the information that you needed to not take a long trade in the ES Mini as you were completing that A to B equals CD. That's why you then want to be able to open yourself up to taking in more information from the market as it provides it to us, and that set up the next A to B, larger A to B equals CD down. And the key here on this A to B equals CD pattern was how price moved off of that C point. In this case here, it moved off with a vengeance, and as it did that, it told us that it was going to do more than a 1-to-1 A to B equals C. I'm going to overlay this on the screen here right now so that you can see, the way that this, the tool that I use here measures the A to B equals CD pattern, that the 1-to-1 completed right here in the 13 area. And as you can see, as you got down there, even though this was a bullish engulfing candle, you did not get a confirmation on the second candle. So that said, you can't take the trade right then and there. And obviously, what happened here was the ES Mini moved down and sliced right through that very next level, 1.272. So as it was doing that, it told you that it was going to at least move down to the 1.618 level. What actually occurred was the low was put in at 6:30 in the evening, making a 1-to-2 almost. And I'm going to go ahead and delete the rows down there just so we can pick those up. So it coming into 6:30, it completed 1-to-2. You actually had a bullish engulfing candle right here, but you didn't get a confirmation, so that was no signal to fire away. You then had a bullish engulfing right here, even though it's a small little body. This was both a combination of a bullish engulfing and a hammer candle. You had just a slightly higher close here. You then had confirmation really with this bar, and that was the time at which to come on in and take the trade if you were around at 7, 8 o'clock at night. And what transpired yesterday was we really had two hammer candles. You had this hammer candle here, which I tried to point out in the newsletter. You had this hammer candle right here. So yesterday morning, as the market was opening into the 10, 11 o'clock time frame, you had the market pushed down and was rejected by this hammer candle. The bull's hammer candles are where you are able to easily identify bulls and bears, and they're very important candles, especially when you have follow-through on the following candle, because it's telling you that the bulls are in control of the market, and if they supported you right here, the next time price moves down there, especially if it's recently, the bulls ought to step in. And in fact, that's exactly what happened here with the market. Now, the market in this 11 o'clock time frame, 10:30 time frame also was coming up against this hammer candle right here. So you had two areas where you had bulls that were, inside the market. And then just as on the A to B equals CD down here on the ES Mini, as you came off that C point, you had conviction. You also had the same thing on the way up here. And, last night it came into the 1.618 area. All throughout here, nothing but some real noise. It's coming up right now. You've got the market just pulling back really slightly. There's really not much of a significant pullback here, as of 3:15. And what I'll do quickly here is also just go take a look at the currency chart. So that's just the update here on the ES Mini. As again, if we pull this back, you can see well above the session lows where the full moon was put in. In fact, if you do just simply from the low there up to the high, you can see at this stage the market has not even pulled back to the 0.618 area. It's why I still expect to see the market drift higher and preferably drift higher into next week on Tuesday, and we'll certainly cover that as we continue to take a look at this. But the market's going to do its thing, and then we'll go ahead and make our trading decisions. But if we do take a look from the currency aspect right now, what is occurring is the U.S. dollar index is again trying to pull back, and the red line going across the screen here really would allow the U.S. dollar index to get back inside its lower part of the range. That's everything below the red line. This swing point right here happens to be the January 13th high out at 82.04. So you can see it rejected it once, but the euro is showing strength. As I've tried to point out in the newsletter, it's continuing to make, the euro on the 120-minute chart is continuing to make higher highs and higher lows. So even though the markets are trading off right now, down 70 points, it's not in sync with what we're seeing inside the U.S. dollar index. So one of the two is out of whack. And right now, my call is the market is out of whack, not the currency market, but the equity market is a little bit out of whack right here. And so anyway, so that's what's going on right now with the currency market. We'll come back to the markets. Let me go back to the presentation here because it's easy for me to just look at the markets and get off kilter. So let's continue with the presentation now. For those folks that are new, and there's quite a few new folks here, I'll just cover this. The data that I'm looking at inside when I take a look at lunar and planetary aspects all comes from the New American Ephemeris. It's from Starcraft's Publishing. There's the phone number if you'd like to order an ephemeris. I certainly do recommend it. It's a great tool to have. And so from the lunar trading strategy, the other thing that was going on, and I'll go back to the chart because it'll make it a little bit easier because I can blow things up here, but the one cycle that has really been working well, and I wish I had identified this sooner, but it has been the moon conjunction Pluto, and there is one remaining aspect left inside this cycle. It really ends up being a 55-day cycle, but what you can see here is each time the market has moved down into it, within a couple of trading sessions, it has made a good short-term bottom. And so it going all the way back into the April 2011 timeframe, it made a bottom. In June 2011, made a bottom. As the market was coming down in August of 2011, and the market came cascading, rushing down, you had a moon conjunct Pluto right there. The same thing in October 4th. You know, these two very important lows out here, this aspect was present. And so not coincidentally, November 27th, you had that same aspect that was present. The market was moving down. Now, in these next two out here, even though the market didn't move down into them, this aspect still held as a low. So as the market moved down into it, it did not get violated, or certainly did not get violated right away. This one here had the shortest run, which was 2, 4, 6, 8, 10 trading sessions, 8 or 9 trading sessions is what it looks like. The market moving down on April 12th, and what was present was this moon conjunct Pluto. And then as the market was moving down into this last Monday, not this most current Monday, but the previous Monday, you can see that also was present. Now, there was a number of other aspects present coming into the Monday area, because you had the full moon, you also had perigee on Sunday, and we had that 16p index date. But what I can find that's consistent amongst each of these lows as the market was moving down into it, the one consistent lunar phase that's in there happens to be this moon conjunction Pluto. So certainly coming into July 30th, that doesn't mean the market moves down till July 30th, but coming into July 30th, that is the last remaining cycle, and you can bet we'll place a long trade coming into that, seeing how well that it actually has worked. I will just go ahead and put this on the screen here to make it a little bit larger for everyone to see, because I know off of the presentation it's a little bit difficult. As soon as I can find it up here, I thought I had it up here, and of course I don't. If you give me a moment here, we'll be able to I'll be able to grab it, I think. There we go. Give me just a moment here, folks. Sorry about that. I thought I had everything all set. Okay, so now we'll come right back to it, and this way I'll be able to blow it up just a little bit more for you. The problem when I do blow this up is it loses I end up losing, for whatever reason, I'm not sure why it's working on this chart here, I'm losing the actual area, so I'm just still going to blow it up. But, this area here, this is the June 4th, and what you had present here was again, moon conjunct Pluto, the full moon, the perigee, and the 16p index date. So I apologize about it when I do blow it up at losing. So I'm going to skip right over this. Let's go back to the presentation here, because that wasn't doing what I wanted it to do. So back in the presentation, let me continue on here. So what do we have on our schedule next? Well, that is this coming Tuesday is going to be a new moon cycle. Tuesday, June 19th. At this stage, I'm looking for that to potentially be a high in the marketplace. That is the normal cycle inside bear market phases. You buy on the full moon, you sell on the new moon, and I believe that we are back inside that phase. So we'll see how the market responds to that. You also have on Saturday is the next apogee. So for those of you that are able to chart the S&P futures contract, the ES Mini, you'll be able to mark the line. I would mark the close of Friday as well as the open on Sunday night, and I would watch price along both of those areas. With any luck, they'll be very close in price, and it'll be very easy for you to go ahead and play either being long or short the market. And on the ES Mini, what I do is I just use a $5 5-point stop, so it's a $250 risk per contract out there. And I get jostled in and out sometimes of the market, but it still always proves to be a good trade over a few-week period of time. The we're not going to talk about real quickly here the daily aspectarian. That is at the bottom of the ephemeris, and at the bottom of the ephemeris, the daily aspectarian contains by each day for each day exactly what the angular alignments are between the planets, and on each day here it lists the number of aspects. Now, what we really are taking a look at here when we're taking a look at planetary index data is nothing more than counting up each of those aspects. The aspects that are most important, though, really are what are referred to as major aspects, and major aspects end up being these major angles or positions. In this case here, we'd call 90 degrees square opposite, 180 degrees, trine 120, sextile 60, conjunction back to 0. And if we take a look at, if I go back here real fast, inside here you have both major and minor aspects, and the minor aspects happen to be these four up here. So these four angles, but those are, if you were going to try to map, and just like I overlaid the moon conjunct Pluto on those charts, if you're going to try to identify an aspect that has an impact on the market, and one of those aspects that does have an impact on the market happens to be Venus and Uranus. But these, if you were going to take a look at the aspectarian, you would also see these minor aspects that are in there. Now, I'm going to go over the 16P index date, because we also have coming in next week is a 3P index date as well. And that's why I'm looking for the market to move up into that time period. And the work that is included inside the newsletter, and I'll review that here, is the work that was originally done by Dr. Ruth Miller on the original ephemeris. Did not include, so if you do get a new ephemeris, it now includes 4 planets/asteroids that are in there, and that information happens to be contained inside this area. The original work that was done, those 4 were not present inside the ephemeris, so that forced me to go back and redo the work that Dr. Ruth Miller did, that Larry did, so that we could take a look and understand exactly when an anomaly was occurring. And so here's just some information about that, about those other 4 planets that are in there. And in fact, Ceres here, which is an important aspect, happens to be the Roman goddess of agriculture. This is on top of the Chicago Board of Trade actually in Chicago there. So for whatever that is worth. Now, as we come into the rest of June here, so last Wednesday we had a 16P index day. And my work shows that when you have these planetary index days, that the low or the high does not need to come in on that day, or even one day on either side of it. It can be more than that, as I have mapped out the 16 planetary index days. The same with the 3. Now, in this case here, you see I've got 4 columns. One says ephemeris time new aspects. One says ephemeris time old aspects. This is just simply done based on Eastern Standard Time, and both based on new and old. And what I mean by old, I mean the original work that was done by Dr. Ruth Miller and Larry, because when they did their work, even though they did not have all of the aspects in place, it still worked to actually show changes in market. So, for example, if we were just simply using the New American Ephemeris, because that's really all that's being published right now at this stage, and you were going to go ahead and start counting planetary alignments that were occurring on a day, and you actually got to the calendar day of June 18th, you would simply have counted 5, and you would have said that was not a P-index day. Because as we take a look at the distribution table here, if you have 5 planetary aspects occurring on one single day, it falls inside the average, as you can see. So the ephemeris time, whether it be on the old or ephemeris time on the new, it falls inside the average range, and you would not actually have picked that up. So when I went back and I did my 300-year study from 1800 to 2100, I wanted to make sure that I was aware of the actual days that were based on the original work that was done. Geez, I hope that made sense. But because to have just simply thrown their workout, to me, didn't make sense. It made sense for me to be able to track this both based on the new data as well as the old data. And so that being said, what we do know, because I've got that information digitally, what we do know is that taking a look at June 18th, you actually have a 3 p-index date. And why? Because what I was doing as I came and was counting everything is I was throwing out these 4 aspects that happen to show up in the daily aspectarian. So I hope that's clear to you. So that way I'm able to catch all of the actual potential turn dates in a market, and this happens to be June 18th, happens to be lining up with the lunar phases that we have going on as well. And it's important for us to understand that because look at what occurred just simply last Monday as the market was moving down. And why it works, folks, I have absolutely no idea. I just simply know that I map things out on the charts, and if they work, they work. Now, the remaining planetary index dates that we have up and coming, once June 18th hits, you have another one right before July 4th weekend. July 3rd will be as a Tuesday, and a trading session market will be closed on the 4th and back open on the 5th. You have another one in the middle of July, August, September, and then October. And then I believe that is it, but I'll continue to do some further checking. Any questions on the if you have any questions on the P-index dates, go ahead and type those in. At the moment, I'm going to just go ahead and switch over here now to the 50 and the 200-day moving average, and I want to make sure that I give you the formulas for that, how it is that I calculate it, and how it is that if you were using a package such as Ensign software, how you would go in and you would actually make the changes. So the 50 and 200-day moving average on a daily chart is oftentimes what people, money managers, and folks will take a look at. When the 50-day crosses through to the downside, it's referred to as a death cross, meaning that you should really get out of the market or out of the way of the market or change your position to a short position. Likewise, on a daily chart, if the 50-day crosses up through the 200-day, that's a signal. And again, this is a lagging indicator, a signal that you should go long into the marketplace. Now, there's 5 trading days in a week. And so if you wanted to put up a weekly chart and you wanted to understand what that 50-day and 200-day would look like on your monthly chart, you have to do a conversion. Because, each candle in your monthly chart represents 5 trading sessions. So, therefore, the settings on your the 50-day and 200-day moving average is the equivalent of a 10-week and a 40-week, and all you're doing is nothing more than just a division problem of dividing 50 days by 5, 200 days by 5 in order to get your 10 and 40. Likewise, if you were going to take a look at this on a monthly chart, you would also need to go ahead and make a modification. That modification is trying to identify how many trading days are there per month. And people do this a number of different ways. I just simply have found that either of these two work. I typically use this one here in the very right, which means that you have 5 days a week possible for trading, 52 weeks, so that's a total of 260 days. The market is closed for 9 days of the year for holidays, and so therefore I just simply have taken 260 minus 9, 251, and I just simply divide that 251 by 12 to come up with an average number of trading days of 21.667. Then all that I'm doing is just like we did here on the weekly. I'm just simply dividing 50 days divided by 21 in order to come up with my equivalent on a monthly basis of what the 50-day moving average would look like, and also the same on the 200. You get different results on your charts simply because now I'm using exponential moving average versus simple moving average. Exponential moving average is giving you different weightings on the prior candle as opposed to a equal level of distribution. And I consider that to be important. So you will see different numbers. You'll even see different numbers with inside my newsletter giving you the 50-day and 200-day moving average, whether I'm looking at a weekly or a monthly. And So if you have any questions about that, please type that in, and I'll show you how I actually am able to do that, just in case you happen to use Ensign software, so I can show you. So Dave says, Steve, we're down over 100 points today. Is it possible we head down into the 18th, and that is the bottom, then bounce, or is this a flush, and should we take a long at the close today? Options expiration week is tough to trade. It's a great question, Dave. What we'll do here maybe in about 10, 15 minutes is just take a look at the volumes and take a look at the retracements that are going on in the in the marketplace at this stage. When I take it, it's tough it's difficult for me to give you the all clear that we should go along. I would rather see the market go test the lows of last Monday on lighter volume and then give you the signal to go along, and or we just simply wait for the sells pattern, the Gartley sell patterns that are out there. I think that's the better trade from a longer term trade. And so the real question becomes whether or not you're an intraday trader versus just simply trying to catch the longer-term trend. And right now, there is no longer-term trend. It's called a market consolidation period and a chop. But there are some great intraday trades out there, and I'm actually tinkering with some ideas for those of you out there that where I would be sending out intraday trade signals to go long and short. It would be different than our normal style of trading. And using the Twitter alert service to do that. So I'm trying to find a way to be able to do that so that it would be timely enough in order for some of you to trade. I may want to find a few folks out there that can, where we can test this system off of the normal channel to just see how it would actually work, to make sure that there's enough communication of getting in and out. So if you do have an interest in doing some intraday trading, why don't you send me an email at steve@tfnn.com, and we'll see if we can come up with that. Because we have had a number of periods here where the market has moved sideways and consolidated, yet on a daily basis there's been good trades, both going long and short out there. But it's a different strategy than what it is that we do. So I'll come back to that question, Dave. Is there 50 and 200 minute or hour moving average crossovers from shorter time frames? There are those Hardy, and I won't get into those just yet. But yes, you can do the exact reverse math out there. I will suggest that it works better on the 10-minute charts than it does on any other charts that I've been able to find out there. So hopefully that helps to answer your question. You can just do the reverse math, just like I did here on the 50 and 200-day moving average. Let me continue on here. Let me find my next spot. So I did include in yesterday's email for each of you, because this is important. This is the Dow 30 as of June 11th, and what I did is I also gave the weightings. I think the weightings might have been as of June 10th, but this was the current weighting with inside the index. And I suggest that you do this for anything that you might be also trading, just to get an idea of what the longer-term perspective is, and maybe trading, in the direction of the trend. And so when you just simply add up the top 10 positions inside the Dow, so you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I've got to do the quick math here because I, for some reason, left it out of there. But you got 12, 18, 28, 38, 48. It looks like about 50%, 51, 52%, all the way through Walmart represents 50% of the, so 10 of the 30 stocks represent half of the actual index. And as you can see in those top 10 going through Walmart, the majority, 70% of them happen to be in a cash mode or a sell mode out there. So I think it's important for, this system will work both on, depending on how you manage your portfolio, will work on individual stocks as well as the actual index itself. And I had a number of questions from folks saying, hey, if you have a crossover, they didn't actually say hey, but if you have a crossover in the Dow, does that mean you get out of everything? And the answer is, if you have if you were if you're inside your portfolio were IBM and Coca-Cola and Walmart, the answer would be no. But when you do have a crossover like that, the index will tend to start pulling everything down. So you just simply have to manage that from a cash standpoint. But you can do that with each of the stocks, and I would also suggest that you would do that with any of the ETFs that you might trade, especially if they're the sector ETFs. It's very easy to go over to the Spider's website, SPDR, and you can type in the XLE or the XLF, and you can there's an area there where you can download the entire holdings as of the prior evening. It gives you these weightings, and in a period of about 4 or 5 minutes, you can just take a look at the top 10 stocks inside there and understand what's going on from a longer term standpoint. Let me see here right now. I'm going to switch over to actual charts right now and continue to take a look at some of the charts that folks had sent in or had requested. So I'm going to take a look at some of the mutual funds where I actually want to start right here. Okay, so these were some of the mutual funds that were sent in by folks. I'm just going to start in the upper left and move through. So here is this is from Western Asset Core Bond Fund, and you can see, again, this is the 50 and 200-day, and for anybody that would happen to be inside this is giving you a signal to stay inside this fund here. And you can see this is great for being able to get you in and out of the marketplace. So this set of signals works on anything, works on any fund on a monthly basis, and really helps you to be able to preserve cash. If we take a look at this, and these are all different types of funds that we have out here. Here's the Touchstone Sands Capital Fund. Over in the upper left-hand corner, folks, and you'll see that on the chart, that's where it's giving you the current reading. Obviously, as I move my cursor here. So right now, as we're over the month of June here, you can see you do have the 50-day truly turning down pretty significantly. And when it does tend to turn down like that, if you just simply go back and take a look at the charts here where you have this very large downturns, it's giving you a signal to truly be careful. Now, I wouldn't get out at this stage because you haven't had the crossover. So, if you were still inside the Touchstone Sands Capital Fund, you would go ahead and stay in. But if you do get that close below there, or certainly the close below there at the end of the month, what I would do is I would go ahead and go to cash. I would close that out, and I would not get back in until it went positive. Until you had the 50-day moving back over the 200-day. You may, you may lose out on some opportunity, but it may cost you a little bit more to get in. But the whole idea here is to you never know where a market is going to go to the downside, and so therefore you want to miss out on these big chunks going down. And so here, the market did move down in this, but you can see it stopped. Just like that's a possibility of what could happen here. So that was on the Touchstone Sands fund. If we take a look at the Matthew 25 fund, same thing here. You would go ahead and stay in this. The crossover is a ways away from potentially crossing over. So this is a fund that I would still be staying in. And this is a tool that certainly you can use, but a tool that you could use also to be able to help your children. And again, if you have some funds that you're using to manage your 401ks, business work related, go ahead, and if you don't have the charting tool, feel free to go ahead and send me those symbols. Now, look, if everybody sent me 5 symbols, I would have about 1,500 stock charts that I have to go through, and I wouldn't be able to do that in 24-hour period of time for sure. But if you do send me a few, I will, personally try to get those off to you so that you can understand what's going on inside the fund. Another request came for the permanent portfolio fund. The ticker symbol's up here. Now, I didn't always have a chance to go back and identify whether they were Fidelity or Vanguard. In this case here, you can see this gave you the crossovers. So my recommendation here would be to not be in this fund. I don't know what it holds. I don't know what is inside it. I just know that I would not be in it, this having given you a crossover going back into the April time frame as you were coming into the month of May. So I would not be inside this. So if we take a look at this Vanguard Dividend Appreciation Fund. You can see here right now today you're very, very close to a crossover. So the moving average is the 50 days. The number that it gives you is 5604 versus 5590. And if you take a look at the Fidelity Contra Fund, again, I don't know what's inside here, but I would go ahead and stay inside this. You have not had a crossover, but there's one that seems like it is on the horizon out here. If we take a look at this Vanguard Real Estate Trust, you can see that you would stay in this. You would have gotten out in this case here right in the August time frame, maybe somewhere right around the 50 and change, and you would have been back in maybe about 57.50 right here in the end of December time frame. And but you would have avoided, as this was pulling back, you would not have used this in order to be able to buy a bottom or to sell a top. But the idea here is to have good long-term cash management strategy, and that's what this tool really does. You've got this BlackRock equity dividend fund as well, just like the other dividend fund that we were looking at. This is getting very close to a crossover. This is about 10 cents away, from on a moving average standpoint. So that is on those funds. I have these additional funds right here that were requested. So if we take a look at the small cap fund, now any small cap fund pretty much that we look at is showing that it is in a sell signal, and we can go take a look at the actual Russell 2000. So you can see that in the Guggenheim S&P midcap, this is a midcap fund, that the signal has been given to go ahead and exit this fund. And so I recommend that if you were in this, that you would certainly do that. Signal has been given. This Berkshire Capital Growth and Value Fund, this happens to be one of the number 2 funds. This has produced, I think, about 30% over the last 3 years, so it's averaging about 10% per year. But this suggests to stay inside this value fund. That's on this. You've got the Vanguard Short-Term Treasury Fund. So some folks might think that going into the short-term Treasury Fund would be a safe bet, and what the Vanguard short-term Treasury Fund is showing you is that's not the case at all. You would have exited this fund back in the January to February February timeframe for sure, and you should still not be inside the Vanguard short-term Treasury Fund. Now, what all funds will do is they'll use cute names, such as the New America Growth Fund, though, so people will make decisions based on the name, not necessarily knowing what's inside there. But clearly, you can see the T. Rowe Price New America Growth Fund is something that you shouldn't be in. Gave us that signal in May, continues to widen, and so if you were inside the T. Rowe Price Fund, I would recommend moving out of that. You've got the Delaware Pooled Trust Focused Small Mid Cap Growth Equity. This happens to be the number 1 fund in returns that it has produced, I believe, over the past 3 years on the growth side. However, even though that's the literature, if you were to look it up in the literature, what this is telling us right now in the month of June, we're getting the signal here that this is the time to be out of this fund until this turned back. Now, the month is not over. It is only June 13th, and so the way that these moving averages work, because we are looking at a monthly chart, that you could be on a, this could turn back up. But if I were inside this fund, seeing that this thing has turned at this stage, I would absolutely be ready to have a quick trigger. Or you could even be safe right now and just simply you have options just to get out and you can get back in. You're not going to miss a huge part of any move. We'll finish this set of funds off here. The Alpine Dynamic Transfor, I think it should be Transformations Fund. This is actually the number 3 fund out there with regard to returns over a 3-year period of time, and this here has clearly given us the cash signal or sell signal, and you can't short this fund, but it's giving you the signal to be out of there. So I hope that this is giving you a pretty good idea between the Dow 30 stocks that we were looking at, and I gave you the table on that. Between these funds that are out there, and again, my outcome is to be able to help you to make those decisions. Now, on the charting software, I've received a number of emails from folks, and when they take a look at their charting application, it doesn't allow them to make the adjustments. And in my case here, if I just simply pull up any chart, well, let me just go back to the monthly. Let's see here if this is it. That was not it. Indexes, okay. So if I just simply go back to the indexes, and you know the New York Stock Exchange obviously gave the signal. I'm going to go ahead and just simply pull this down, and I'm going to go ahead and delete the actual index off here. Now, inside the Ensign software, for any of you that do use that, or something if you're looking to be able to do something inside your software application, maybe it looks something like this. So I'm going to go ahead and place that study, the moving average study, on my screen here. Now, this is the default. This is not the correct one, so I have to open up my window that allows me to change those moving averages. It just so happens that in tab number 6, I already have those percentages inside here. And, if I wanted to change this from an exponential to a simple moving average, it's very easy to do. In this case here, I just simply have to go back up and I have to change this. So if we use the simple moving average, you can see it's going to give you different results, totally different results. In fact, it's going to give you such different results that you're not even going to have the crossovers. So sometimes people have asked, why am I using the simple moving averages? Just simply the exponential moving averages and using these tools provide you with, in my opinion, the proper results. So what you are looking to be able to do is to be able to adjust the moving averages to correlate to the number of bars that you have that it is measuring. The more data, the better. And, look for the ability to be able to modify that. Usually just a quick call to the software company whose chart you use. They typically can answer that question for you. Let's go take a look at the markets themselves. Let's go back to the question from Dave here, and let's go take a look at today's volume and exactly what's going on inside the market. So one of the things that, and I'll start with the Qs here. And when we start with the Qs, what still has not occurred, and the reason why I would certainly struggle to go short would be that, you have this very powerful island reversal candle formation out here. I showed you I showed you in the newsletter a few times the 4 and 5 candle reversal pattern that happens to be out there in the Dow index. When you take a look at the island reversal inside the Qs here, we take a look at the pullback today. The volume so far, and there's about 10 minutes left in trading here. So 44 million. We know there's going to be a bunch of volume that comes in during the last 10 minutes of the trading. But 44 million down today. That's going against 50 million from June the 11th. Still hasn't been able to push down into those lows here. It's not being able to bust it down. This was the bearish engulfing here. I'm going to get rid of that because that was not confirmed. But at this stage here, right now, you've got some pretty decent support at the 61.52. I would prefer to see 61.52 be tested, close back above that on lighter volume, and then Dave, that would give me, that would say to me, okay, I could go ahead and put that type of trade in the newsletter for folks to take, because we would have rejected a gap up, and that island reversal still would be in place. So that's what's going on inside the Qs. If we take a look at what's going on inside the SPY, so now instead of the Qs where you have 100 stocks, we're taking a look at the SPYs where you have 500 stocks. The 9-period moving average happens to be the blue, and we can see that the 9-period, certainly has been holding as a pretty decent support line. This island reversal is also still intact here, so not even close. If we take a look at just the retracement from last Monday up till this Monday at the high, right now it hasn't even made it back to that 0.382 area. That doesn't mean that it can't, just as you were pointing out, that the market could clearly pull back into the June 18th time frame and then take off from there. Certainly my preference would be to see on the SPY would be to see in the A to B equals CD form, and especially as we start coming into the holiday, not the holiday weekend, but the summer weekend. I kind of consider summertime almost all holiday. What it looks like, there's this possibility of setting up a tiger Gartley. That means that the market has to trade above the June 11th area up into about the 138 standpoint. And what that would set up is that would set up about a 0.618 retracement, I believe. Maybe it's 0.786. Yeah, 0.786 retracement. So right inside here would really be our range that we would be looking at. And what would be nice is it would come back and it would test this swing point here from May 1st, May Day. Which would be a large move up, and it'd be a large move up, and people would think that things were hunky-dory. So when I take a look at what's going on inside the SPY here, I'm not really concerned about the fact that the market's down 102 points still doesn't tie out to what's really going on inside the dollar index. Now, yes, the dollar index. You see the dollar index today is pushing with volume. It's pushing this swing point all the way back here with volume today. It's rejected it on price right now, but because the U.S. dollar index is going to be trading after the market closes and all night long because of what goes on inside the euro, euro here, let's go put the 120-minute chart up because this will probably make even more sense to us. So the euro doing what it's actually supposed to do as it continues to move up. This wide-ranging bar right here that came in at the noon time frame, and it got very close to 0.786. This tells me that the euro actually wants to trade higher because of this long-range price bar. And, it's actually one of the longer-range price bars out there, wider-range price bars going all the way back to the lows that were put in back at 10 o'clock on the 120-minute chart going back to June 1st. So, you got a pullback here right now. But when you get up into this 0.618 area or 786, you're going to go ahead and just simply do a normal pullback. I mean, that's what the market is supposed to do. It's supposed to let people off of the elevator. So at this stage, I still am seeing higher highs, higher lows inside the euro. And if we go to the daily chart, this just says to me it's a perfect setup for summer. Whether or not it plays out that way, I don't know. But it seems like a perfect setup for summer. Now, what I did want to do also is I want to go back to the trade that I threw out in the newsletter to you this morning, and that is this trade on Great Basin Gold. Great Basin Gold does not at all look to me like it's going to go out of business. And the way that I want to go ahead and take the trade on this, folks, is this is like buying an option, only it's buying an option that's not going to expire. The only way it expires is if they go out of business or if we go ahead and we close out the trade. So what I'm in the way that I want you to trade this, and you have to make a decision whether right now it's trading at around 67 cents, and from a chart standpoint, it looks like it'll pull back into the 57, maybe even a little bit lower price point. But it looks like it'll at least pull back to about 57 cents. The difference, and what I want you to do is take whatever your free trading capital is, and I want you to take 1% of that. So for every $10,000, 1% equals $100. Then you're going to assume that everything that the purchase price is total risk. So you have no stop on this trade whatsoever. And what you would do is if you bought it today at 67 cents, you would be buying 150 shares for every $10,000 in free cash flow. And likewise, if it happened to be trading at 57 cents today, or if it does pull back to 57 cents, you'd be gaining about 25 extra shares for every $10,000. So you would need to do the math on whether or not it makes sense for you to pull the trigger today, whether it makes sense for you to pull the trigger if it pulls back further. And this is the type of trade where it's a longer term trade for our portfolio, and this has volume at the highs on the monthly chart in the $3 area. Looks like that's really its first target. This is the type of trade that, quite frankly, you could go ahead and purchase how many of your shares, and you could ask the company to, in fact, just send you the certificate. And just hold on to their certificate and put it in a safe. But this is the type of trade that I would expect that we'll have for a while. If it takes a few years to make 500%, then so be it. I'm happy to wait that length of time. But this is also not one of these stocks where you load up and you back up the trailer here. Again, we still use our money management principle. And in this case here, we're using that 1%. So anytime that you run across a stock actually that you have a interest in. Maybe you know something about the company, and it's a low-priced stock, especially trading in the dollar range, dollar or less range. The best way to trade that, quite frankly, is to just simply use this technique here where you're taking 1% of your capital, you're putting everything at risk. Now, as the trade starts moving in your direction, you can add to your trade. But your initial basis of the trade ends up being this 1% here that you've put at risk, and then you can add to it along the way. Probably one of the best stocks to quickly take a look at, and I'll put up on the screen here, and you can see the type of outcome that you can have when you do something like this. I'll just put Ford up on the screen. I'll put Ford up on the screen, and we'll go all the way back into the 2008 time frame when Ford was trading at $1 per share. So it's trading at $1 per share, and that was the low. You could have used that exact same strategy, and of course Ford did get up to a high of almost $19. And that took a few years. That took until January of 2011 before it got all the way up there. So it's another great trading strategy for you to be able to use on stocks like that, and it's a good money management principle. So, as always, time flies. Let me see what else I can try to cover here in the next minute or two. The other trades that we are looking at, I'm looking at that natural gas trade. This happens to be the UNG chart. However, it is really, as I mentioned, I think it might have been on Monday's newsletter, maybe it was last week, our trade is really going to be based on the natural gas contract. It's impossible to identify what the actual price inside the UNG will actually be. I'm looking for this gap here to get filled. This happens to be April 25th. The high there is $2.09. We'll probably go ahead and pull the trigger once it gets to $2.11. We'll go ahead and give it that extra 2 pennies. That's when we would take a look at going ahead and taking a trade in UNG. If we take a look at AutoZone, I put this as a short candidate inside our newsletter today. I'm looking, this is setting up to be a nice Tiger Gartley pattern. This is making an A to B equals CD up. This was the B point right here. You can see the volume as it tries to trade up. So I'm looking for it to get into that 397 area. We will likely pull the trigger right here when it would get to the 394 area, which would be the swing point from April 27th out there. So thank you for your time, as always. And if you have any questions, it'll probably just be easier right now if you just go ahead and send me an email at steve@tfn.com. And have a great afternoon, folks. Take care. Bye-bye now.